Morning, ladies and gentlemen. I've got 20 minutes to share with you how Momentum Investments thinks about building out our equity solutions. And I suppose most importantly, how do we consider passive and smart beta funds? So let me start with a quick question. Show of hands. Who knows that Momentum Investments has two smart beta funds, a value fund and a momentum equity fund that have been running on live data with more than 10 billion worth of assets for the last 2 years? Show of hands. Who knows we have two smart beta funds? Sure, one of our worst, best kept secrets. But let me share with you this morning what we've actually done. So I think for me, I'm truly excited around this whole concept of how we see passive funds and smart beta funds being implemented globally, and certainly how I've seen them being implemented locally. It's been a story of exponential change. And to me, there's nothing that explains this concept of exponential change better than what we're seeing here. Anyone want to hazard a guess what we're looking at in this picture? It is a 4 megabyte hard drive being loaded onto a plane in 1956. It weighed nearly 1,000 kilograms, and you couldn't buy it, but you could lease it for the bargain price of $35,000 per annum. And 60 years later, we walk around with this device in our hands. Phone, GPS, you name it. And this really is a story of exponential change. I think before we start looking at what have we done in the smart beta space, I think it's important just to take a step back and think, just to recap on what is the difference between a normal index fund and a smart beta fund. And I think really, if I look at what a normal index fund is, or your market cap weighted fund, it's your classic buy the market cheaply, buy the market efficiently. So if you look at a capped Swix index fund, you're effectively buying the top 160 shares. If you look at a SA property index fund, you're buying the top 21 or the top 22 shares. But effectively what it's doing is it's holding shares in that particular fund based on the size of the share in the market. So if you're looking at capped Swix, you're holding Naspers at 10%. It's really putting the market at the center of the universe. So it's assuming that we need to hold shares based on their size in the market. In a smart beta fund, it weights the shares in the particular fund by anything other than size. So it'll weight the shares based on a forward-looking dividend yield, based on a PE ratio, based on a 12-month historic price return index. It's weighting the share based on anything other than size. And I'm going to run you through the two smart beta funds that we've built. The beauty of these index funds, though, is that it actually takes the whole emotion out of investing. So once you as advisors and your clients understand exactly what you bought, it's actually very easy to keep clients invested through time because it takes all of the emotion out of it. We can look through concepts and themes as what's happening in the various like cryptocurrencies, global warming. It's very easy to keep our clients invested through the cycle. So let me run you through what we did when we actually went and built out our two smart beta funds. What we did is we went back and we had a look in the SA market at the 4 primary drivers of return, or the 4 primary themes that we needed to consider. The first one being size. So we looked in the SA equity space and we looked at how did the large cap shares compare to their past returns relative to the mid and small cap shares. And you could see there were times when they did better and times when it wasn't so great. The second theme we looked at is we went and looked at value, the concept of a value risk premia in the SA equity space. And this is just looking at how that particular risk premia returned. It's not how our fund did, it's just looking at that particular risk premia. And you can see value even had times when it did exceptionally well, and it's had a long time when it just hasn't been the theme that you actually want it to be in. This is the first smart beta fund that we built, and it's called, on our unit trust platform, and you can access it through our wealth platform, the Momentum Value Fund. The second one we built is we went and built a Momentum Equity Premier Fund, smart beta fund. This was a bit of a naming challenge for us because unlike the first one, if we were going to try and name this one, the Momentum Equity Fund sounded like we'd lost our way slightly, so we ended up calling this the Momentum Trending Equity Fund. It's the second smart beta fund that we built. And you can see this particular risk premia, it's also had times when it's done well and a few times when it hasn't performed. Really not surprising, because if you look in the SA equity space, our market has done exceptionally well in the last probably 10 to 15 years. So not surprising that this particular risk premia has featured very strongly. And the final risk premia that we considered was growth. How's growth performed in the SA equity market through various cycles? What was more interesting to us, though, is when we went and looked at these various risk premia, is how had they performed relative to the market over different 3-year rolling periods. Starting with value, we had times on a relative to the market, so how did this particular risk premia perform relative to the market? And as you can see, it's had times when it's performed roughly 7-8% better than market, and times when it was slightly underperformed the market on a rolling 3-year basis. We looked at market, we looked at momentum, and you can see the momentum risk premia sort of at times has done exceptionally well, but also performed poorly. Deep value, I'm sure no one would be surprised by this picture. It's had times when it's done well and times when it's spectacularly imploded on itself. But the real beauty, what we found, was if you blend these 3 different strategies together, you actually get a phenomenal result. So actually blending the core equity building block to blend in styles of value, momentum, and market over a 3-year rolling period, in no 3-year period that we observed, did a blend of these 3 strategies underperform the market. Now that's a compelling story. So yes, you've got a slightly tailored in answer, but it's over no 3-year period did it do worse than market. And that's a very compelling story. And it talks to this whole theme of when we actually build equity strategies, it's all about blending different styles of equity managers together. It's not about just choosing different managers, it's about blending those styles together. So when we look at the actual equity building block, there's 3 things that we consider. The first thing is we actually build out equity strategies that we need to diversify by style. Style, value, trending, size, and we've actually just recently launched a quality SA equity index fund. Then when we look to actually implement, we need to then further diversify between different managers. And finally, I'm probably the most excited. If I look back 6-7 years ago, the market was fixated with this whole concept and story about is it active or is it passive? Thankfully, we've moved on to a much, much better place now where it's all about how do you blend active and passive together. That's where the world is now. It's no longer about active or passive. It's about how do we blend these 2 strategies together. And the real beauty now, if you want to actually access styles, so if you want to access a value style or a trending style or a quality style, again, you can do it actively or you can do it passively. It's not about only implementing this style in a sort of active way. So for me, this is where the market's really moved to, and it's really an exciting space to be, that if you as an advisor or your clients are going to try and choose a particular style, any one style can have a very wild journey, as I've shown you. Who knows what the next 3 years is going to hold for value, what the next 3 years is going to hold for momentum, what the next 3 years is going to hold for the quality risk premium. I have no idea. But the beauty, which we have a lot more certainty on, is that if we blend these 3 styles together, we can actually build out equity building blocks for your clients that have a far more robust forward-looking payoff profile. And it's all about, for us, it's not about trying to time these particular risk premiums. It's incredibly tough to sit here and say, on a forward 3-year basis, we think value is the next big, best thing to go for. Absolutely no chance. It's all about blending them, putting together a particular blend of these risk premia, and building out solutions that are going to be far, far more robust on a forward-looking basis. So then what we went and looked at is we said, okay, well, let's have a look at each of these particular styles. So if we look at value, and we look at quality, and we look at momentum relative to the market. This is how value is performed relative to the market. This is how quality has shown out, and this is how momentum has shown out. Who knows in the next what will be best in the next 3 years? What we then found, and show of hands, has anyone considered or actually started implementing into your client portfolios the risk premium of quality? Show of hands, anyone? We've done a lot of work in the last 18 months to consider this particular quality strategy. So you've got value, you've got momentum, and size. Those are probably the 3 most common themes. But we did a hell of a lot of work to go and say, based on our particular construct, if we blend together in our equity building block value, trending, and size, we get a particular 3-year return relative to the market. If we go and add quality into that particular equity basket, we actually get a payoff profile that's slightly better. So there's fantastic evidence, and I'd be very happy to go and share it with you, that shows that if you actually build out equity solutions, adding quality into your client's mix, again, produces a more sustainable and a more market resilient solution. Then I think it's important to consider, here's a fascinating stat. I was actually horrified. On the S&P 500 shares, there are more smart beta funds on the S&P 500 than there are shares. How on earth, as advisors, do you possibly choose a smart beta fund in that kind of world? Just not possible. Luckily, in the SA market, we don't have that level or that many smart beta funds for you to consider. But not all smart beta funds are equal. So for me, if I have a look at smart beta funds, there's 4 things that I would consider and 4 things that I would ask you to consider when one looks at various funds. The first one is the word index. So to use the word index in a unit trust seems market intuitive, but to use the word index, there's 2 things that you have to have. First of all, you have to have a particular index that you are tracking, such as the Capped Swix index, SA Property Index. And secondly, you need to have a calculation agent for that index. So if you do a smart beta fund, and I want that particular smart beta fund to be called the Momentum Value Index Fund or the Momentum Trending Equity Index Fund, I need to have appointed a calculation agent for that particular index. So that costs you about 150,000 Rand a year. If I do that, clearly for us that was a big no-no because it pushes costs up. And the second thing is, and probably more importantly, is that if you have a fund manager that's now going to be tracking a particular index, first of all, I need to pay 150,000 Rand to use the word index. Secondly, as my fund gets assets into it, I then need to pay a licensing fee based on assets under management. How counterintuitive is that? So I launch a fund on my own IP, on my own value strategy. I need to pay someone 150,000 Rand to run that particular calculation agent index for me, and I need to pay a licensing fee as I get more assets into my fund. For us, that was just an absolute non-starter. More importantly, though, is that what we also found is that if you have a smart beta fund that at a particular month end, it now says, right, these 3 shares are out and these 3 shares are in, the absolute worst thing that you can do is for a manager or for your portfolio manager to go and say, right, this particular index changes as of close of business tonight. So I need to go and buy these 3 shares and sell these 3 shares, and I have to do it today. What a load of nonsense. Nobody behaves like that. So the best solution for our clients and to go and actually get the best outcome is to say, right, these 3 shares are in, these 3 shares are out, but you execute on a market neutral, on best efforts, whether it takes 1 day, or whether it takes 5 days, or whether it takes 2 weeks, it doesn't matter. Just get it done in the most efficient way. So to be forced into trading, to say, well, my particular index changes tonight, I must trade tonight, is just not at all sensible. So those are 2 big things that we considered, and that's why our 2 smart beta funds, which you'll find on the Wealth platform, Momentum Value Fund and Momentum Trending Fund, are both smart beta funds. 100% smart beta, rules driven, but execution is not rules driven. That the portfolio manager will do as he sees market opportunity to actually execute out of sort of various share baskets. The third thing I would consider when one looks at various smart beta funds is it a single factor smart beta fund or is it a multi-factor smart beta fund? And what I mean by that is that when you actually form a view on which of for argument's sake, the 25 best value shares or the 25 best trending shares, do I look at the universe with one lens? So I look at, for argument's sake, broker earnings forecast or 12-month price momentum or net free cash flows, or do I use multiple factors to form a view on which shares I would hold? And without a shadow of a doubt, and I'm sure you would agree, the best way to do it is to have a multi-factor index. So you look at the shares with one lens, for argument's sake, 12-month price momentum. You look at the same shares on a 24-month price momentum. You look at the same shares based on broker earnings forecasts. And using multiple factors of screening, we get our view of which are the best, for argument's sake, 25 shares for us to go and hold. If you only look at the universe in one lens, it can do spectacularly well for a long period of time and then spectacularly implode. So for me, I would want any smart beta fund to be a multi-factor smart beta fund, looking at the world in multiple lenses. It's just more robust. How did it work for us? Interestingly, in our value fund and in our trending fund, both smart betas, when Steinhoff blew up at the end of 2017, we had no Steinhoff in either one of our smart beta funds. Had we been running these funds on a single factor index, it would have probably found its way into one of those funds. On a multi-factor strategy, it was certainly not on either fund. And the final one is tracking error. How concerned is the smart beta fund with its tracking error relative to market? Does it ignore it? Is it going to be somewhat market cognizant? There's no right or wrong. It's all about how much noise and how much market deviation can you and your clients take relative to what's happening in the market. So in our smart beta funds, when we built them, our starting point was saying we don't care about the market. We're going to try and capture this risk premia as purely as we can. What we found, though, is that the tracking error was then too high. It was just major swings around what was happening on capped SWIX. So we had to build in a slight element of market cognizance. So in our smart beta funds, we can't take a position on any share that's more than 5% away from its market size in a normal capped SWIX fund. So for NASBAS, even if we don't like NASBAS, we have to hold it at 5%. Not pure, but it keeps that tracking error slightly more in line with what's happening in the market. If you were to ask me honestly, I would rather not have that particular limit in, but it just keeps the sort of fund tracking error slightly better than what it would be without it. Again, there's no right or wrong there. And those are the 4 things I would consider. Have a look at any smart beta fund. Is it using the word index? Yes or no? At least now you understand why we have chosen not to use it. How does it rebalance? Does it factor in any sort of market cognizance? And is it a single factor or is it a multi-factor model? How have our smart beta funds done? And this, I'm sure, will surprise you. We've been running these 2 smart beta funds for more than 2 years. So they launched in April 2017. We've got about 3.5 billion rand sitting in the unit trust and about 7.5 billion rand sitting on balance sheet portfolios, but running the exact same strategies. If we look at how it's done for the 2 years ending 30 June, the peer group average in the ASISA General Equity Survey was 4.7% per annum return. Cap SWIX did 4.6% per annum. So the 169 or 168 managers doing slightly better than the market on average. Momentum's value fund, which is a smart beta fund, so it's completely rules driven, completely systematic, just the execution is not rules driven. 15.2%. Wow, looks pretty active. It's a passive fund, ladies and gentlemen, a smart beta passive fund. And our trending fund, 15.3% per annum. Anyone surprised to see that? Did anyone know they were smart beta funds? At least it's a big thing. I mean, to be honest, this is spuriously close. It just happens to be as of that 2-year period, but they were moving around one another through sort of various market cycles. But that's a phenomenal result for completely passive implementation. And this is where the world's now changed. If you want to add in value as a strategy into client portfolios, it's not about only choosing active value managers. Here's a building block you can choose that actually gives you access to that risk premia in a completely systematic, passive way. So if we look at on the wealth platform as well, we have a unit trust called the Momentum Core Equity Fund. Again, you really need to understand what is in there, but this is a completely passive equity building block that effectively blends those 4 strategies together. Cap SWIX, value, momentum, and we've just added quality in now as of the end of July. So the Cap SWIX tracker fund is 25%, value is at 12%, momentum as a risk premium at 33%, and quality has now been implemented at 30%. Momentum Equity Fund on the Unit Trust platform, or on the Wealth platform, exactly the same asset mix, but the implementation is with active managers. This one, the implementation is into Cap SWIX tracker funds and the 3 smart beta funds. How's that fund done? I'm just showing 3 managers, and these are the 3 managers that I would find in 90% of client portfolios. The first one rhymes something with 50 shades of. Manager B and Manager C are the usual suspects. I'm not going to, there's no need to rhyme them out. But there's our core equity fund, which is a blend of a capped SWIX tracker fund and those three equity styles: value, trending, and quality. 9.8%. Completely passive. A wonderful diversification away from active managers. And this is a sensible block for clients and advisors that don't necessarily have a view, I want to add some more value managers, or I want to add some more trending, or I want to add more quality. For a multi-style equity building block, this is it. Pre-blended into those three smart beta styles. I will tell you that this has only recently had quality put in, so this track record is based largely on Catswick's value and trending styles. But it's got quality in the blend from 1 July. And what I'd maybe leave you with is it's a wonderful story. I just love having new audiences that I can tell my story to. But it's a story that I heard at an investment conference many years ago. And the story went as follows. Sitting on a park bench one afternoon with these two gents, sitting, having a chat. On the one side, a genius, and on the other side, a moron. And when I heard the story, I was like, yo, pal, where are you going with the story? This doesn't sound like it can be great. But here are these two gents sitting. So they start chatting, and the genius said, you know what? I think we should play a game. But the way the game's going to work is I'm going to ask you a question, and if you don't know the answer, you need to give me a hand. He says, but don't panic, we'll make it fair. You can then ask me a question, and if I don't know the answer, I'll give you 500 rand. So the moron thinks about it, and he says, yeah, that sounds like a great game. So the genius says to him, okay, it's my game, so I'll start. So the genius says, and he says, okay, can you explain to me Einstein's theory of relativity? So the moron sits, and he thinks, and he thinks. Eventually he opens his wallet, and he gives him 50 rand. So now it's his turn to think. And the moron sits, and he thinks, and eventually he says, okay, what goes up the hill on 3 legs and comes down the hill on 4 legs? So the genius is like, wow, writes it down, works on it. After 5 minutes, he's got nothing. So he opens his wallet and he gives him 500 rand. But now he's like seething. So he looks at him and he says, okay, pal, you tell me then, what goes up the hill on 3 legs and comes down the hill on 4 legs? So the moron sits, he thinks, opens his wallet, gives him 50 rand, says, I don't know, you got me.